Hello, everyone. Welcome to this session. This is going to be a really interesting session because we're going to learn about presentation disclosures. The agenda for today, as I said, is presentation disclosure, and we will cover the following topics in detail in the coming slides: contract assets and liability, overview of disclosure requirements, disclosures around contract balances, performance obligations, significant judgments which we need to disclose, and disclosure around cost to obtain and fulfill the contract. Contract asset or contract liability is created when either party to the contract performs its what? If the entity performs its obligation in transferring the good or service to the customer, then contract asset is recorded. And if customer performs by paying the invoice amount, then contract liability is created. Contract asset is the right to consideration in exchange of promised good or services if the rights are unconditional in nature on something other than passage of time when the consideration becomes due. In case the consideration is unconditional in nature, that is, only passage of time is required before the payment becomes due, then it needs to record it as receivables. The entity needs to provide sufficient information to the users of the financials to segregate balances pertaining to contract asset from receivables. Contract liabilities are obligation to transfer goods or services to the customer for which the entity has received consideration. For both contract assets and liabilities, entity need to segregate the current and the non-current portion on the balance sheet. There are more enhanced disclosure required under the new standard to provide sufficient information to the users of financials. This is because the current standard provided very limited information around revenue and its related item. The objective of the disclosure requirement is to provide sufficient information related to the nature, timing, and uncertainty of revenue and cash flows arising from contract from customers. The entity needs to provide both quantitative and qualitative information around revenue. Some of the disclosure requirements are around disaggregation of revenue, contract balances, performance obligation, cost to obtain and fulfill the contract, and other significant judgments used by the entity around the standard. As the entities would be providing more information in the financials, it needs to make sure that it has all the processes in place to capture all the relevant point and report the same. The new standard requires the disaggregation of revenue from contract with customer into categories that depict how the nature, amount, timing, and uncertainty of revenue and cash flows are affected by economic factors. Each entity, depending on the nature of its business, needs to determine the disaggregation category to be presented in the financials. The entity needs to consider the following points to determine the same. Disclosures around revenue presented outside the financials like press release or investors report. Information reviewed by the chief operating decision maker to evaluate the performance of the company. Any other information used by the management to evaluate the performance of the company or taking any decisions related to company's operations. So on the basis of these three categories, the entity needs to decide and determine the different categories of disaggregation of revenue. Now, there are a few examples prescribed by the standard, but these are examples. There are no minimum disaggregation categories required by the standard. Each entity, depending on the kind of businesses it deals in, needs to determine what disaggregation of revenue they would disclose in the financials. Some of the examples stated in the standard are disaggregation based on geography, type of good or service, timing of revenue recognition, based on sales channels, based on the contract type they enter into with the customer, and based on the customer category and the market in the market of operations. Disclosures around contract balances. The entity needs to disclose the following information around contract balances: the opening and the closing balances of contract assets, contract liabilities, and receivables from contract with customers, the amount of revenue recognized in the current period that was included in the opening contract liability balances. The amount of revenue recognized in the current period from performance obligations satisfied in the previous period. An example would be changes in transaction price, an explanation of how the entity's contract and typical payment terms will affect its contract assets and contract liability balances, and an explanation of significant changes in the balances of contract assets and contract liabilities. Well, all these disclosures will provide more information around contract balances to the user financials and also help them in understanding how the balances have moved and the reasons of the movement of balances. Disclosures around performance obligation. An entity provides the following information about its performance obligation. When the entity satisfies its performance obligation, that is, on shipment, on delivery, as services are provided, or on completion of service. Significant payment terms, that is, whether the contract has a significant financing component or not. Details around consideration is variable and the variable consideration is constrained. The nature of goods or services that it has promised to transfer, highlighting any performance obligation to arrange for another party to transfer goods or services, obligation for return and refunds, and other similar obligations. Types of warranties and related obligations, and the aggregate amount of transaction price allocated to performance obligations that are unsatisfied at the reporting date. The entity also needs to provide quantitative and qualitative explanation of when it expects the amount to be recorded as revenue. As a practical expedient, an entity is not required to disclose the transaction price allocated to the unsatisfied performance obligation if contract has an original expected duration of 1 year or less. The entity applies a practical expedient to recognize revenue at the amount to which it has a right to invoice, which correspond directly to the value to the customer of entity's performance completed to date. An example of this would be service contract in which entity bills a fixed hourly amount. The entity also discloses whether it's applying the practical expedient and whether any consideration from the contract which the customers is not included in the transaction price. That is, whether the amount is constrained and therefore not included in the disclosures. Significant judgments when applying the standard. An entity discloses the judgment and changes in judgment made in applying the new standard that affects the determination of the amount and timing of revenue recognition. Specifically, those judgments used to determine the timing of the satisfaction of performance obligation, the transaction price, and the amount allocated to performance obligations. For performance obligations that are satisfied over time, an entity describes the method used to recognize revenue. That is a description of the output or input method and how those methods are applied and why the methods are faithful depiction of the transfer of good or service. For performance obligations that are satisfied at a point in time, the new standard requires a disclosure about the significant judgments made to evaluate when the customer obtains control of the promised goods or services. An entity also discloses information about the methods, inputs, and assumptions used to determine the transaction price, which includes estimating variable consideration, assessing whether the variable consideration is constrained, adjusting the consideration for a significant financing component, and measuring non-cash consideration. Allocate the transaction price, including the estimating the standalone selling price of the promised good or services, and allocating discount and variable consideration, and measuring obligations for returns and refunds and other similar obligations. Disclosures around cost to obtain and fulfill the contract. Under the new guidance, the entity needs to disclose the closing balance of contract incremental and fulfillment cost capitalized in the financials. Along with disclosing the closing balance, the entity also needs to disclose the amount of amortization and impairment of these contract balances during the financial year. It also needs to mention the judgments made in determining the cost incurred to obtain or fulfill the contract and the way it has determined the auto amortization period for the contract asset created on the balance sheets. This brings us to the end of the presentation. In this presentation, we have understood the presentation and disclosure requirement and the new revenue standard. And this brings us also to the end of the training session for IFRS 15 revenue for contracts with customers. Thank you.